to your Monday Futures Market Outlook for April 25th, 2011. This is Patrick Serezna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, 5-day complimentary memberships are available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles the market has gone through. When we still remain bullishly above that 80-week moving average, and the market continues to progress to the upside targets for that we've set out for the highs of the year. At this juncture, the market looks like it may even want to break to a higher high on the short term, but inevitably at some point this year we're going to see a profit-taking cycle that is going to come back down and have a proper weekly chart retracement on the downside. We don't necessarily believe that that profit-taking cycle that will occur will be one of a new bear market, but rather just the natural ebb and flows from which markets advance and decline. We're going to be very carefully watching how the markets come into this May cycle up along the highs around this 1340, 1380 area. So let's take a look at our key intermarket observations. We have an intermediate bullish bias on that market, even though we've already reached many of the upside targets we've set out for the year. The US dollar continues to keep its existing downtrend in place, and the deterioration of the dollar is a very crowded trade. But so long as the US dollar continues to deteriorate, we will see the trends in place on the indices, commodities, and bonds that has been in place up until now. And so we're waiting to see when the US dollar finally does bottom, and when it does, we should see a big intermarket shift. We're anticipating a market top on the S&P 500 somewhere around this 1340 to 1380 area, just slightly above from where we are. So maybe we're looking at maybe about a 2 to 5% upside potential still in the market. There is even one measured move that even targets that 1400 round number on the upside. But until the S&P actually breaks to a higher high, we always have to consider the possibility that we're looking at a double top along this 1340 test. But nonetheless, at this point, there's still no indication of anything bearish. As we get into the May month, we're going to go into a period where there's traditionally some form of distribution coming into the market, and with the market being already quite overbought and the commodity markets being so stretched, there is a chance that the market will have some sort of a catalyst that creates a profit-taking cycle. And so really in the second quarter of the year, if the US dollar bottoming does kick in, then we're going to see commodities and the stock market put in some sort of a top, and then subsequently have a corrective pattern that should take about 3 to 4 months of selling to really work itself out into the third quarter. When we take a closer look at that E-mini S&P 500 futures contract, we can see that we're now consolidating right near 52-week highs up along the high. And one thing we've been talking about is that so long as that 1290 to 1300 level area held the support lines, that there was room for that market to reverse and break out bullishly on the upside. At this stage, if the bulls can get any good push through to new highs, we should see a move to 1360, even 1380 on the upside. Like we were suggesting, there was even one measured move that suggested as high as 1400. Really at this juncture though, we do anticipate somewhere up along those zones would be where the bigger picture topping formations will develop for the year. It's just a matter of now seeing where and how it all develops. Next year, I want to take a look at the US dollar index futures, so we can see where all the bullishness in commodities and in the markets are coming from as the US dollar continues to deteriorate. It broke its previous lows around that 75.50 area and really just started some very aggressive selling on the downside. Really at this stage, we're starting to see the completion of a number of measured moves lower, and we fully anticipate that the US dollar will find some significant support down here. It doesn't necessarily have to be this week. And so over the next 2-3 weeks, we're going to be watching where and how low the dollar index goes, how the bottoming formations start to develop and where a strong counter rally could develop. We'll be watching particularly on Wednesday the reactions to the Fed minutes and subsequently the interviews with Bernanke. If there's something said there that in any way supports the dollar, it could be used as a catalyst to create a very strong counter rally. But that's only something we want to be observing rather than actually speculating that it will turn at that point. Next, I want to take a look at copper futures, and copper continues to be very sideways range bound. We've certainly are reaching a level where copper is being distributed, and there is overall strong overhead resistance, in spite of the fact that a lot of other commodities and metals have been able to push higher levels. The very bullish trend that's been in place in copper has really almost died off to an outright trade range bound environment. At this stage, we don't think it's likely that copper will have any dramatic selling while the US dollar continues to decline the way it is. But at some stage, if we have a robust US dollar rally and broader commodities markets sell off, copper could break that 410s below support line and actually begin a much deeper correction on the downside. We have been targeting the highs of copper for the year to come in somewhere around this 480 to 500 level. And if for whatever reason the US dollar was able to still muster up a further decline, maybe down toward the 72 level, we can't rule out the possibility that copper will make one more push to higher highs. But again, we remain skeptical about the sustainability of any rallies. Next year, I want to take a look at gold futures, and I also have a chart on the silver future. I want to discuss each one in a little bit of detail. When gold broke above that 1440 area, it really opened the window for gold to continue on its rise. There's two levels we're watching for measured moves. First of all, this 1520 to 1540 area is the completion of a shorter measured move. There's a bigger picture measured move that even targets this 1580 to 1600 area. It's very interesting that gold is very methodically rising in comparison to silver. We'll pull up that chart in a moment. But really at this stage, we are coming to a completion of a number of moves. So really at this stage, both gold and silver may continue higher, but it will be on what we call extended moves. It's going to be on a sheer amount of momentum that's coming from this being such a hot sector. And if we'll see where and how the tops come in here, but at some juncture, we believe we're at the tail end of this rally. So when we pull up the silver futures chart here, we can see that we've now reached the state of parabolic rise. You can see just by the slope of each rise higher and higher. We're now at a stage where there's a real risk of a blow-off top in silver. While we certainly will not and cannot rule out the possibility that silver may even go to $55 or even $60 in a very short time span, such as even a week. But at this stage, anybody that's in the silver market must be a short-term trader and have the discipline to be able to get out of that market very quickly as it turns. At some juncture, these kind of parabolic rises have a decline on the other side just as steep as its rise. And so at some point we may see a $10 to even $15 drop in silver in a very short period of time. But that doesn't mean on the short term silver isn't going higher still. So we're watching to see where and how far silver can make this push before we see a blow off top. Next year I want to take a look at the crude oil futures contracts. And crude oil continues its methodical rise, again driven by the weak US dollar. Every time crude oil sells, it's been able to make its recovery. We're now again at some overhead resistance where it's made its highs from earlier. But we do, in the bigger picture, we've been targeting a move to the 115 to 120 area. Now there's a measure move that even targets as high as 118 to 122. Ultimately, so long as the US dollar is in this decline, if that lasts a week or two on the downside, then we certainly could see crude oil make pushes up into these highs. But as eventually, when we see the unraveling of the US dollar short trade, at some point all these commodities will begin some sort of a corrective pattern off of these highs. But at this stage, respect the trend that's in place. Finally, I want to take a look at the 30-year Treasury notes, and this is particularly interesting because 30-year Treasury notes tend to be an indicator of inflation expectations. And in spite of rising commodity prices, we've really seen 30-year Treasury notes stabilize and stay far more range-bound than in bearish negative breakdown fashion. And so this is an interesting sign that there is accumulation occurring at the 30-year Treasury notes, and a lot of the inflationary fears are subsided a little bit. Really, at this juncture, if there's any bullish breakout on the upside of the 30-year Treasury note, that could very well be correlated at the same time with eventual reversal in the US dollar and the correction in commodities. That was your Monday Futures Market Outlook. Thank you for joining me.